I think in the course of VC, in the history of VC, venture capital dollars have been earned the most when VCs have invested in companies that are 0 to 1. And by 0 to 1, I mean companies that create state shifts, companies that create new markets, new technology models, new business models. And for multitudes, what we're excited about is investing in companies that create shifts in belief systems. And it's an area that a lot of VCs don't necessarily have the wherewithal, the interest, or the ability to invest in because it can seem very nebulous. With technology, there is a due diligence underwriting process that enables certain VCs to be able to have a sense of like, okay, does this tech work or not? With belief systems, with IP that is more qualitative, in nature, it's a lot harder to do. And so when we invest in companies that, and also incubate companies that, as I like to call it, explore the edge of human consciousness, it is an area that requires a lot of understanding of what's going on culturally, what's going on from a sort of, we'll call it like systems shift perspective within humanity. And as big as those words and as nebulous as those words sound, I think where we're at is a moment in time where the IP for companies is not just gonna lie solely in the technology stack, it's gonna lie in the brand, the network, the community of people around it. Yeah, it's a really good question. So I think right now we're in this, what I call like a primordial soup moment for venture. And what I mean by that is that since venture capital as an industry was incepted in sort of like the 40s or 60s, depending on how you're counting, the sort of business model of venture hasn't really changed. And right now we're in this moment where I think venture is undergoing a lot of change, whether you think about it as like the caterpillar turning into a mush before it becomes a butterfly, or in this case, maybe like two different kinds of butterflies. I think venture capital is having this moment where it is innovating within itself. And what this means is that more capital than ever has entered into venture, and funds are getting larger and larger and larger. At the same time, what you also see is that the outcomes for venture-backed companies have gotten bigger than ever before. We've never had a moment in history where you can conceivably look at companies and say, okay, this company has a shot at becoming a $100 billion plus business. And that has created opportunities that I think a lot of larger platforms have gone after, but it's also created an opportunity to rethink, okay, where does that classical venture model belong, right? And how do we go back to basics in terms of investing in great founders, doing interesting things that have the potential to change the world in industry, however you want to sort of define that market, without necessarily needing that company to be $100 billion plus, right? And so, in terms of answering the first part of your question, how has sort of my investment philosophy changed? I'll answer it in a slightly different way, which is the one thing that I think has remained really consistent about my investment philosophy is that I've always loved to invest. No surprise, a lot of VCs say this, but I've always really loved to invest in ideas, areas, or industries that are a little bit undervalued or sort of a head scratcher. And so when I was at Firstmark, we were one of the first firms to invest in New York as an industry. And at that time, New York was like a speck on the map compared to the Bay Area. And everyone was like, oh, are there any big tech companies that can ever come out of New York? And now 10, 15, oh gosh, almost 20 years later, you've seen the answer to that. New York is the second largest venture startup technology market in the world, which is amazing. And with Female Founders Fund, it was the same thing where sort of my thesis got a little bit more fine. It wasn't investing in a geo, it was investing in a archetype of founder that was undervalued by the rest of the market. And now with Multitudes, where we're investing is in a in the broader idea that diversity of thought, right, that having a really unique perspective and really unique background enables founders to have these really unique ideas, right, that can go on to change the world. And how we're doing that with our investments in human consciousness is not just investing, but also incubating ideas, because we think the incubation model helps us better equip ourselves as a fund and then our companies to go into this primordial soup of like, what is venture going to become, and come out of it the other side with more autonomy and autonomy and also just like ability to direct our path. Yeah, I think the funding gap is definitely still there. I'll give you some interesting stats about Women in VC. Women in VC actually is celebrating our 10th year. And so I co-founded Women in VC back in 2015 with about a dozen women in New York in venture. And at that time, I was like, oh my gosh, there's a dozen women in venture? Like, what an incredible accomplishment. It's more than 10. And now Women in VC is almost 7,000 women across over 3,000 funds, 200 something cities, 70 some odd countries all over the world, right? Every single inhabited continent, continuously inhabited continent in the world. And it's really incredible progress. And I think that underscores the rise of women in positions of where they're able to invest in and support companies. That's really great. I think what has lagged the growth of women working in venture is the allocation of assets going towards those female-led funds. And that is a opportunity that I think the smartest VCs recognize and are working on addressing, because the LP underwriting process isn't dissimilar to the VC underwriting process, right? You're trying to find the best of the best assets to invest in and to get into them as early as possible. And so I think for the smartest LPs, it is great if you're in the established funds, right? But to win, not today, but to win in the next 10 years, it's all about investing in the new players that will go on to become the platforms of tomorrow. Yeah, I think a lot of LPs have seen the stats that talk about small funds outperforming large funds, emerging managers outperforming established managers, early stage funds outperforming growth stage funds, diverse partnerships outperforming homogenous partnerships. I think a lot of LPs have seen this data. And I would also guess that a lot of LPs agree with this data. And so the question is like, what is the disconnect, right, between knowing these facts to be true and actioning on it? I think honestly, some of it is creating an action plan, right? Creating a thesis, a testable hypothesis, and then investing money behind that to see that hypothesis come to light. Of course, VC returns, as we all know, take time because companies, especially the best companies, take time to mature and grow into what they can ultimately be. But I also think that there is this inertia to action that if the LPs can overcome that, it can create some really incredible results for the emerging VC community. Because the nice thing about emerging venture is that the funds aren't that large. And so with a relatively small amount of capital in absolute dollars, you can make a relatively outsized impact for your investments. And then because of all the things I mentioned, the outperformance, right? You can expect that those dollars that you invest will be put to better use than what they could be in a more established fund or a different asset class. I mean, not to toot my own horn, but I do think that with the rise of AI, what we've seen historically is that it has continued to be cheaper to start a company, right? Back in the day, like to start a company, you're like, all right, I got to buy servers. I have to rent a room to put these servers in. To start a software company, it took $2 million, right, out of the gate. And now, because of not just the rise of AI, but AI building upon all these other platforms that have existed, it has become cheaper, easier, faster than ever to start to build software, right? And to start a business. And so what that means, I think, is that the IP for like what creates long-term defensibility is moving away from just pure play technology defensibility to defensibility. Again, I go back to these more qualitative traits, right? But the brand, the feeling that your customers have when they interact with you, right? The community that you build around it, the network that you're able to create. All these things will become more and more important because the technology defensibility is getting thinner and thinner, and a lot of companies that use technology as an enablement layer, right, for what they're doing versus building for technology as a core IP.